as we've seen just recently, price action has turned quite a bit more volatile over the last few weeks, and essentially volatility has tended to pick up really since the Fed turned a bit more obviously hawkish back in June. So that bid for havens, the bid for refuge is likely to I think add to the support factor for the US Treasury market going forward. When we look at the performance of equity markets, I think for me, it's probably one of the bigger risks. And when we look ahead and think about what might go wrong or what could go wrong, it's going to be perhaps quite difficult for markets to digest, equity markets, that's to say, for equity markets to digest an aggressive round of Fed rate tightening next week. We can see that the breadth of US markets is not particularly strong at the moment. And there is, from my point of view, there is an underlying concern here that equity markets generally are perhaps looking a little bit fragile as we head into 22, with a fairly significant, potentially, round of Fed tightening coming down the pike. So again, demand for refuge, demand for safety, certainly something that will help also keep the 10-year well supported.
Yeah, and indeed, it sounds like a job for U.S. Treasuries and for the dollar. What are you penciling in for DXY for next year? Shaun, we've heard calls as aggressive as 100 or slightly north. What about for yourself?
Yeah, I wouldn't rule that out. I mean, we're looking for essentially another 3 or 4% in the dollar index over the course of the next 12 months. I think, a lot of, from an FX point of view, obviously currencies tend to front load a lot of the expected tightening into the price action, and we've seen the dollar perform particularly well again since the middle of the year, really, when the Fed really started to sound quite a bit more hawkish. I think the markets had been expected, but I still think that maybe there's a bit more juice to squeeze out of this move. There's I think a fair degree of seasonality in FX, and for me, I think we can expect perhaps the dollar to really have a good first half of the year, next year at least. As we start to price in Fed tightening. Other central banks, other jurisdictions are looking less likely than the Fed or the Bank of Canada, a bit closer to home for me, to raise interest rates. And we think that that spread difference, the policy differential, is going to be a key driver of FX performance over the course of the next 12 months at least. And that should give the dollar and the Canadian dollar a pretty good support base against the major currencies.